Let's get into it. Welcome, everyone. Thank you for participating in E3's ERCOT Market Forecast webinar. We're definitely going to be talking about a lot of very live, recent, and ongoing dynamics in the market. So just starting off with an agenda for today, a quick intro to E3. We'll keep this part brief so we can get to the good stuff with you all. We'll give you an overview of our price forecasting, kind of the work that we've been doing. We'll talk about ERCOT recent market trends, and then we will go through some of the key highlights from our recently updated forecast in Texas, which runs through 2050 and beyond. We'll talk about our approach to nodal modeling and value, as we understand and appreciate that that's of interest to a lot of our clients and material for PPA settlements. We'll talk about our approach to energy storage modeling, and then we'll have some time for Q&A at the end. We'll wanted to just do a couple of administrative items here. So everyone will note that, of course, in this webinar, you're all on mute. And if you have any questions, there is a Q&A chat. Please feel free to type your questions in the chat on an ongoing basis as we go through the slides. And we'll take some time at the end to cover as many of those questions as we can. All right, without further ado, let's move on and I'll give you a brief overview of E3, who we are. I imagine that E3 is familiar to many of you. So again, we'll just kind of keep this brief. We are a technical and strategic consulting firm. We really specialize and focus in the energy sector, not just electricity, but fuels as well. And we're really focused on the energy transition in terms of the core analytics that we provide services to our clients. We've been around for over 30 years. We were founded in the mid-'80s. I guess we're approaching 40 at this point now. We've got 130 plus full-time consultants. We've got 5 offices: San Francisco, New York, Boston, Calgary, and Denver. And we do about 350 projects a year, give or take, across a very diverse client base. So we definitely kind of punch pretty heavy for our size. And we do a lot of deal flow as well. Our clients are divided into 3 major types. We have investors, developers, asset owners. Those are the clients, of course, that Grant and Tali and I work a lot with on the market price forecasting side. We have our public and nonprofit clients, including state agencies. And we have utilities and system operators. That's a lot of our resource planning work, which also informs our market outlooks. We support a very wide range of asset classes with our fundamental analysis. And we'll talk about that a bit further in a moment. So next slide, please. Okay, so we've got 3 major practice areas, largely oriented around the analytical focus, and of course having some commonalities to different kinds of clients who engage us. On the left-hand side, at the bottom of the screen, you can see the range of the value system of the grid that we analyze and support, from the economy-wide kind of energy systems, multi-sectoral analysis for decarbonization, to the electric power sector itself, and then the bulk grid system, generation and transmission, and then going to the load side, behind the meter generation, grid edge technologies, and even retail rate forecasts and analysis. We've got, as I said, 3 major practice areas: climate pathways and electrification, asset valuation and markets, and integrated system planning. CP&E primarily handles questions around long-term climate carbon mitigation trajectories, and also houses a lot of our analysis around changes in end-use consumption from electrification, EVs, building electrification, and climate risks as well. Our integrated system planning group focuses exactly on that: long-term resource plans, including procurement support to off-takers and utilities. And then our asset val and markets group that I sit in as a director is responsible for our market outlooks and our price forecasts, as well as strategic advisory and due diligence and transaction support. The next slide. We bring a lot of tools to the table to run the analysis that we do. I won't cover these in depth, but just want to highlight a few of the core functionality capabilities of our toolkits. We have kind of market level tools at the top and project level tools in the bottom row. In the market level, largely we're talking about, everything from using Plexos as a capacity expansion and production cost simulation model. That's the anchor model for our market price forecasts. We also have another long-term capacity expansion model that we've created in-house, specifically tuned to analyze high renewable and decarbonized systems. That's Resolve. We have Recap, which is a loss of load probability model that generates fundamental endogenous ELCCs, or capacity contribution values, as well as just running loss of load expectation, testing the reliability of the current and future systems. And then Pathwise is our multi-sectoral stock rollover decarbonization tool. For a project level, supporting project analytics, we have Restore, which is our main model as a price taker optimization model, takes in prices and dispatches batteries primarily, as well as hybrid assets or gas plants. Recost, we'll talk about in a couple slides. That's our cost model that estimates resource costs that feed into our market model and our expectations around PPA pricing as well. We'll be talking about the bill that recently passed, and that will, I think, be of interest to most folks. And then Rematch helps us analyze questions such as if you're trying to match a portfolio of load to a portfolio of resources, what kind of hourly profiles and marginal emissions result from those combinations. Next. Just wanted to tick through a few kind of major transaction highlights recently. I think the broader takeaway that I want to leave you all with is our forecasts, our market price forecasts are highly bankable, have been used continuously for years in many large dollar, large megawatt transactions, as well as small individual project development and financing projects. In the past 12 months or so alone, we've done over 25 gigawatts of renewable storage and thermal generation in terms of valuation support and financing, in addition to major investments in utilities and transmission assets. We've got a few tombstones on the slide here of transactions and clients that we can publicly disclose. That's kind of the tip of the iceberg of those that we actually do. Again, 350 projects a year, so we cover a lot. And of course, we also cover a lot of advisory support for other clients who are not investors and developers. Next slide. All right, let's get into the forecasting a bit. So I won't read through everything exactly here, but I wanted to just frame up sort of E3's ethos, guiding light principles of how we approach forecasting in an increasingly varied and uncertain environment from a macro and a policy perspective. Generally, the North Star of our forecasting ecosystem is fundamentals-based modeling. So what I mean by that, you can think about regressions can be fundamentals-based because they're looking at historical relationships. But when I say fundamentals-based modeling, we really anchor to capacity expansion, production cost simulation as the major toolkit to inform our expectation of future resource additions to the grid. Production cost simulation, of course, then takes different exogenous, deterministic hourly load forecasts and dispatches a portfolio of online, existing, and new build resources to meet those loads. The resulting intersection of supply and demand on an hourly basis in each market footprint gives us our day-ahead energy price forecast around which we build the rest of our forecasts. We also continually test scenarios and sensitivities. Why do we anchor to this production cost or fundamentals? Largely because we think it's very important, increasingly so in an environment with lots of uncertainty, to be able to draw a clear line and relationship between cause and effect of real world variables as they are modeled. So this much solar has this much of an impact on net load, resulting in this kind of a change in the fundamental price. You can then sensitize a range of gas prices and things on top of that. But being able to connect and draw clear model results between those cause and effects we find is very valuable to our clients and helps support the understanding of where major risk factors are for asset valuation, PPA settlement, procurement, and reliability. Next slide. So we're going to talk about the OBBBA. The topic du jour, short version is everything matters, but what matters most is different depending on what technology you are. I won't cover everything under the sun in that bill, but we're going to focus on just a core couple of factors that we see having a strong influence on technology costs and thus what is built specifically in Texas in the near term. So first and foremost, as everyone is probably quite aware, there were substantial changes to the technology neutral tax credits under the Inflation Reduction Act, the 45Y PTC and the 48E ITC. They're modified for all resources. In general, the window is much shorter for eligibility of those resources. The additional wage and apprenticeship bonus requirements are still achievable if you meet the requirements to claim the 45Y or 48E tax credits to begin with. In terms of depreciation, we actually see just the preservation of 5-year makers and bonus depreciation, again, assuming you meet those initial eligibility windows, which are much shorter for wind and solar in particular. We also have a slew of new FEOC requirements for an entity of concern. We won't cover these in great depth in this particular webinar because we're going to be focused on the implications of these changes in resource costs, as well as loads and fuel price updates and things for the ERCOT market and the rest of the markets. We do forecast all markets across the United States. So on the right, you see the major cost impacts of the OBBBA on resource costs in our estimation. The top right chart provides our levelized fixed cost benchmark estimate for 4-hour and 8-hour lithium-ion batteries, as well as gas CTs and combined cycle CCGTs. You can see that in the near term, there are some substantial tariff impacts that are elevating the cost of 4 and 8-hour batteries prior to this administration coming into office and executing those tariffs. We see that 4-hour storage on a levelized fixed cost basis, not net cone, just kind of the gross cone effectively, is pretty comparable to a new combined cycle, just in terms of dollars per kilowatt year. And then quickly, batteries do become cheaper over time. But again, this is not the net cone analysis. 8-hour storage remains elevated above both a new combined and simple cycle, a gas turbine. On the bottom right, specifically for wind and solar, and again, we have these costs adjusted to different capacity factors and different specific cost drivers in each market. But this is our benchmark kind of US generic cost for solar with the PTC and the ITC or onshore wind. This is modeled assuming a safe harbor. You can see that there's a tariff impact on solar, and also the safe harbor allows for CODs until 2030, unless that changes. So we do expect kind of a range of PPA offers to be with and without the ITC starting in 28, 29, and 30. Once that credit window is completely expired, we do see an increase in costs, most substantially for wind as the PTC rolls off, and for solar, based on an expectation of continued cost declines from fundamentals. And if tariffs roll off after this administration, then we might see a slight cost decline trajectory for solar, all else equal. Next slide. So just digging in a little bit further on the tax credits here. This is just essentially providing some additional detail around those cost assumptions I just talked through. Again, we have been observing and will continue to observe the executive order, Treasury guidance that may or may not be issued 45 days from now or later this year, whenever it comes out, that may squeeze down or raise the hurdles for projects to claim safe harbor. And that window may end up being a bit shorter than 4 years. It's unlikely to be longer. And we also see that the threshold for investment spend to claim safe harbor may be raised above 5%. Projects that are slated to come online in 26 and 27, relatively near term, we think have a very good chance of maintaining their ITC or PTC eligibility. Again, kind of in our current reading of the tea leaves. But projects that have a later COD and are really trying to reach that critical milestone of construction, 5% within the next 12 months, will be more challenged. So that's why we expect a wider range of PPA offers, in the late 2020s, again, under current signed legislation. Next slide. So now we're going to talk about some recent trends in the ERCOT market. So at this point, I will turn it over to my colleague Grant, who's been leading the modeling work for ERCOT. and he'll take you through what we are seeing as the result of this bill, as well as other fundamental updates. Grant, take it away.
Awesome. Thanks so much, Nate. And thanks so much for taking us through a lot of the nitty-gritty details on the impact of the reconciliation bill. And now we're going to fold that into how it is informing our view of the near-term market for ERCOT. But as Nate also mentioned, we're very focused on long-term fundamentals. So we're going to cover both from our recent outlook in this presentation. So jumping in, I always love to lead with this slide just to highlight how dynamic the ERCOT market is. There's a lot going on, and it's really it's important to stay on top of all these different market design or market policy or market rule changes, as they have a pretty strong impact on near term and then potentially some of them some longer term fundamentals. So I won't go through the entire table here, but just to highlight here that in the near term, we're anticipating and actively incorporating items like the new ancillary service that is expected to come online in 2026, which is DRRS, which is a longer term, longer response time product in response to largely out of the Winter Storm Uri package, which is going to help with things like unit commitment and ability to procure resources to handle within-day events. Items like renewables firming, we're always looking at our balance of resources over the long term. Is there enough firm resource to meet the wind and solar demand and also to meet peak load? So that's always a part of our long-term fundamentals modeling. The Texas Energy Fund is quite impactful in the near term, as the project pipeline that comes out of it, the successful projects, will provide a lot of near-term reliability, which, as we'll talk about, is really important for implementing or facilitating large load growth. Items like real-time co-optimization are expected to come online maybe as early as this year, and that is a bit of a tweak to how ERCOT's real-time market and the ORDC is activated. So this is always something we're looking at in getting our peak pricing correct in ERCOT with the $5,000 price cap. Very impactful. So we're always looking at ways to understand how many times a year, what the situations are when we hit that price cap. Large load interconnection as well. We're going to be talking a lot about that. So again, just highlighting, there's a lot going on in ERCOT, and we're always doing our best to make sure that we're incorporating all of these policies into our forecasts, and I'm trying to understand what the long-term impact is. So we'll get into that more as we discuss our long-term results. This is one of my favorite slides here. It's always fun. We're entering the summer season in ERCOT, which means prices are potentially going to be very high, or we might get another less eventful year like we did in 2024. So I'm going to walk you through this. There's a lot of information here. On the left-hand side, I'll start in the top left. So we saw 2023 set some peak load records that were really impressive, tons of peak load growth up to 85 gigs. And 24 started the exact same way, as you can see in the bottom left. Cumulatively, we saw up to about a good 8% of load growth leading into the summer season. And then going back to the top left here, we really saw not really strong heat in the Texas area generally, kind of resulted in that same peak of 85 gigs. So we didn't see any peak load growth, but we saw load growth on the year. So that was a bit of an interesting trend, and items like price responsive load or avoiding 4CP could have played a role, but largely we think that was weather driven. Same phenomenon in 2025 here. We're seeing the year start out very strong with some strong winter and shoulder season loads here. And so the question is, how much peak load growth are we going to get this summer? That really determines everything. So in 24, if we move to the right-hand corner, we saw a record deployment of 12 gigawatts of supply additions, largely dominated by solar and storage. And what we really saw in 24 without any load growth, peak load growth, was that the solar and storage were able to handle all of that load. And we moved from a a strong peak in 23 to about a $30 settle in August, actually weaker than May, believe it or not, for 24. May had some interesting outages that resulted in some peak pricing. So really soft summer there. And what we've seen so far this year is that ERCOT, through their more reports, is suggesting that August pricing is pretty low risk for load shed. Certainly we're seeing the same thing here at E3. We do think there's going to be load growth in 25, but we still have to get through that huge deployment in 24, and we think a similar level of deployment is going to happen in 25. So it's really 26 where we're expecting that peak load growth starts to strip through all of the supply additions, where we get some typical tight summer conditions in ERCOT. So in the bottom right-hand corner, you can see the summary of all of that. The black line representing the actuals with the week 24 summer. And interestingly, the forward market anticipating a very strong settle at 120, in June, right before the season kicked off. So we pulled the forwards again this year. That's the gold dotted line here. Forwards still elevated at similar levels as they were trading last year. And again, aligned with the Moore report, we're anticipating that there's going to be load growth, but not enough to get through all of the solar and storage additions. It's really that 26 time period where we think that load is going to catch up. So that's the near-term outlook. Lots of exciting stuff going on, and it'll be really interesting to see how summer 25 shakes out and what our new peak load is, assuming there is one, but I think that's quite probable given all the load growth we've seen so far this year, if we get some decent heat waves across the Texas region. So that's the near term. We're going to dive now into, like Nate had mentioned, all of the different, near term impacts, like resource costs and how we're incorporating those, and sort of the near term fundamentals and market design changes, how we incorporate all that information and align it with our fundamentals to put out a 25-year plus price forecast. And we're going to start with load. This is certainly before the reconciliation bill, always the hottest topic at ERCOT, and we've spent a tremendous amount of time working on putting together what we believe is a reasonable long-term load forecast. So a lot of information on this slide, but some key highlights. The large load interconnection queue, a bit of an iterative process this time, and we'll get into it in a couple more slides, but really load can only grow as fast as the market can deploy resources to meet that load. So we see things like transmission constraints and resource adequacy constraints really mitigating the highest projections of load growth, scenarios where the entire large interconnection load queue is facilitated. So what we've looked at and what we've modeled here in our forecast is simply the contracted large loads out of the queue. So we add 18 gigawatts of the contracted loads by 2030. And if we look at the large flexible loads, so the queue breaks down into a couple categories. Large flexible loads are able to respond to peak conditions and reduce their peak loads during time of system tightness, which is really helpful for integrating lots of load growth, but not necessarily increasing peak too much. So we look and we added all the contracted large flexible loads out of the queue with a further 8 gigawatts by 2030. So the 2030 number that we have is about 110 gigawatts of peak load from the 85 we sit at today. So some of the fastest growing load across the entire US, and certainly historically that we've ever seen. So in the middle right picture here, that's our peak winter and summer load forecast. And we're seeing those peaks grow from that 85 summer peak at a 4% CAGR, or compound annual growth rate, to 2031. And for those who have been in the power industry a long time, 1% or 0.5% growth was sort of the steady state. And so for us to be projecting a 4% growth rate pretty continually across the entire forecast and getting all the way up to 160 gigs is really incredible. Really interesting time to be forecasting and looking at the impact of such a growth in load here. The last thing I'll note is that we also, something we noticed, and we'll get into this once we get into the pricing, the system load factor in Texas rising from about 65 to 75 has really profound impacts on the long-term fundamentals. And for those who aren't familiar, load factor is a measure of peak load compared to the average. And so as your load factor increases, that's saying that loads are remaining higher on average throughout the year compared to the peak. And that certainly is a story of data centers and large loads being added to the system, whose loads are typically, they have load factors of 80, 90%, and they run around the clock. So this really impacts how the system resource fleet needs to grow. So a quick picture over time. What our load forecast looks like, what we're showing here is our daily profile. So we're taking an average for every single hour ending across the entire year. So the way to read this chart is that starting in the bottom left in 2025, we're expecting in, let's say, hour ending 1 here, that load is on average about 50,000 gigawatts across the year. And so what we're seeing in this evolution is the impact of those data centers. If we go to 2035, we're seeing, as I mentioned, the neighborhood of 20 gigs of data centers by 2035 and another 10 of large flexible loads. And so that's really taking you to an average of 100 gigs there in the middle of the day across ERCOT for the year, which is just incredible to think, because our peak right now is 85. So we're seeing averages well above 80, and that afternoon average close to 100 gigs by 2035. Just incredible load growth, and that's the contracted stuff. So a potential upside from here. As we go to 2045 and 2055, similar story. And you can see as those large loads are getting added, that high system load factor, the evening hours and the morning hours are becoming more important. And especially if we look at net load as well, as we'll see in a couple slides here. By 2055, the electric vehicle loads start to have a bit of an impact, but certainly nowhere near as large as what we're expecting for data centers and large flexible loads, and quite frankly, baseline load growth. So Texas also being a growing market, large population increases, all of those are contributing also to just organic load growth at a much higher baseline than what we've seen historically. So as I mentioned, in this phase, we did a bit of an iterative process. Obviously, there are projections out there where load is, let's say 160 gigawatts by 2030. And we looked at, what's the historic pace of build in ERCOT? How fast do we think the market can move to integrate these loads? And what we found is that a nice equilibrium existed where we're moving at, record paces of, 10 plus gigs up to 13 gigs a year of deployments. And that gets us to the load number of about 110 gigs in 2030 while maintaining reasonable system reliability. Certainly the market is a lot tighter, but it is a level in which we think that the system is resource adequate and is providing reasonable levels of reliability. So a couple other things to note here. As my colleague Nate mentioned, lots of thinking went into how to incorporate the impact of the OBBBA here. And so what we saw for ERCOT was a bit of an interesting dynamic where with the safe harbor provisions that Nate mentioned, developers have a year to safe harbor is the current interpretation. And so what we saw is in the queue in ERCOT, we saw the majority of projects that have interconnection agreements and all of their studies complete, so facility studies and system impact studies. We figured in a year in Texas how quickly the queue has been moving historically, that these folks would be able to safe harbor and get under construction in the next 12 months. So when we look at those criteria of having an interconnection agreement and all studies complete, the large majority of those projects are solar. And so we're seeing quite a bit of solar growth in the near term, as those are the most shovel ready in the highest volume scalable projects. Wind has a much smaller presence in the interconnection queue currently, and we're going to see how in a couple slides here that we're expecting those economics to reshift towards wind as system load factor comes up. So we're all late stage wind projects we're expecting to complete as well. And as Nate mentioned, storage actually had an extended runway of ITC, PTC, or pardon me, ITC specifically for storage. And so in this chart here, we're still seeing very strong storage growth out of the interconnection queue, but we don't anticipate a rush, obviously, to safe harbor. But we do see very strong storage economics as load is growing, and quite frankly, it's going to be a resource that's needed to maintain resource adequacy. So we see strong growth in solar out of the queue and based on the near-term fundamentals. And then for gas, as we mentioned, we've taken all active projects from the Texas Energy Fund, as we think that to maintain reasonable reliability over the very strong 25 gigs of peak load growth for forecasting over the near term, all of that gas is going to be necessary to again maintain a reasonably adequate system. So that's the build. We're at breakneck pace here out to 2030, integrating these large loads. Okay, so now the long-term view. We're sort of seeing the market in, let's call it 4 eras or 4 epochs here. As of right now, we're just entering the load integration phase. So how will the market integrate, as we're forecasting the 25 gigs of very strong load growth in 2030. And as I mentioned, the near term 25, we're not expecting, the summer numbers or a strong winter to bring up those average prices. We're really expecting 26 is where we're going to start to see the pressure of load growth on pricing. So we're seeing 2026 roughly in that 50 area, but then past that, once all of the large loads, that 25 gigs really starts to deploy, we're expecting, levels not seen roughly since 2023, so close to that $80 mark. And there we're seeing many, hours at the price cap over the summer and winter seasons. And as we'll see in a later slide here, this is where we start to see that high system load factor bringing risky price hours, not just in the summer when the sun sets, but really across the entire evening period, and also in the winter months as well. So we're seeing stronger winter loads at ERCOT, and based on historic wind and solar patterns, it brings interesting pricing dynamics. So that's the first epoch. And then we're seeing, as that first tranche of large loads hits the system, that all of the build pipeline catches up to it. And in the case of storage, we see a rush to capture the last of the ITC credits. And so that really has a nice mean reversion period. So we think the market will take a bit of a deep breath after the large load integration. And after some volatility in the market, we think that it's going to attract a lot of build. And if large loads don't continue at the unprecedented pace, maybe go down to about 2 or 3% a year, we expect the market to mean revert to sort of historic levels that we're seeing now. And then we move into what we're calling the market adjustment phase. This is where all of the ITC and PTC credits have now rolled off. And so ERCOT being an energy-only market, with no more credits, we now see the market having to rise to a level where technologies need to earn their full rate of return from the energy market without credits. And so that tends to be in this phase here. We see prices rising to that $80 nominal. And so that is sort of this market adjustment phase. And we think that then gets us to a long-term equilibrium. What's really important about this outlook is that, again, while the large load rush in the beginning, we don't expect that pace to continue forever. There's certainly load growth all the way to the end of this forecast. So we are seeing the need for deployment of all resources long-term. And so we expect that the ERCOT energy-only market to, hover around that levelized cost of entry across the portfolio of gas, wind, solar, and battery storage projects to build. One dynamic we're also seeing long run is that the 2-hour battery deployment that we're currently seeing starts to extend to 4 or possibly even longer durations to meet all of those risky evening periods with the changing resource mix and load factor. So that's sort of the broad long-term fundamentals snapshot. I'm going to take you into a quick look at wind and solar here. So something that we focus on a lot is where wind and solar profiles are providing value on the system and what their generation weighted energy prices are. So here's a quick snapshot across a couple of the ERCOT regions. So some interesting trends I'd like to walk us through here. We're seeing, the near term with prices in 2026 only where we're expecting the load integration to happen. We're seeing some of the lower capture prices, especially in wind. But for wind, as large loads come on, we're starting to see, as I mentioned, that high load factor is distributing some high price hours, typically where wind performs the strongest in the evenings or right as the sun is setting in certain cases. And so we're seeing that capture prices or generation weighted prices for wind, we expect them to rise pretty substantially in 2030 here, when we're seeing a pretty volatile market. And then in the long run, we're expecting, again, as those large loads come on, that the wind profile matches quite nicely with a lot of those evening risky periods, and that their capture prices increase accordingly. Solar, an interesting dynamic, because solar is the predominant technology that is developing out of the near term in the queue. We're actually seeing that during 2030, with some of the stronger pricing, we're seeing a bit of a discount as the market gets oversaturated with solar, as they all rush to safe harbor and build in ERCOT in the near term. And so once that build out of solar happens, as I mentioned, we reach that sort of market, that mean reversion era, and then into the transition into the long term, you see that solar value does increase over time as the market then builds in a manner that reaches long-term equilibrium, and the new builds are recovering their costs. And so we see that there's some appreciation in the 2050 mark there, but noting that the capture price for solar is still much lower than wind long-term. Okay, this is one of our favorite charts from the outlook. As of right now in 2026, we're still seeing the system roughly as it is today, with a bit of, as I mentioned, some strong summer pricing, typically in August here at being the strongest pricing. The way to read this chart is that at the bottom there, we're giving you the months, and it is the 24-hour profile. So the spike, for example, in the 2026 row at the end of August would represent when the sun goes down, and we have those 2 hours of risky system conditions. And so, 2026 looking largely like 25 or 24, where the winter seasons, maybe a little bit of volatility, but it really is that August and July season when the sun sets that we're expecting the most system tightness. And so if we move to 2030, as we talked about, 25 gigs of large load additions, what we're starting to see is that there's these periods where if you get a cold snap in February or March, where things like planned outages are happening and loads are higher than usual, and wind profiles aren't performing as strong as they do, let's say, if there's a wind outage event, or pardon me, a wind, not a strong wind evening, we start to see that with those high load factors, there's a lot of risk to pricing. So we start to see that in the 2030 winter, along with continued strong summers. And again, it's no longer just concentrated in August anymore. We're seeing those large load factors and high data center loads when the temperatures are the highest really start to drive risk even into July and out all the way to October. So this evolves, and as you can see, by 2050 and 2055, it's really only the shoulder seasons that remain I'll say safe or not subject to tight conditions. And in the case of our 2050, you can see that there's quite strong pricing in February and January as higher winter loads with those high load factor data centers really drive a lot of risk there. So an interesting evolution over time that the long-term fundamentals are pointing us to. And so if we look at just a snapshot in the next slide here of what a single day in ERCOT looks like, you can see that that 2-hour peak still remains the most important over time, but you can see that those off-peak slices between hour ending 0 and hour ending 7, they also begin to elevate. So on average, those 2 hours when the sun sets are still the most important in ERCOT, but we're seeing strong pricing across most hours, except for obviously when the sun is on with such a large, when the sun is up with such a large solar deployment. Okay, I'm just time check. We're almost through the fundamentals here, and then I'll walk us through how we're thinking about nodal and energy storage economics. But last but not least, this is my favorite chart out of the presentation here. This really just encapsulates all we were talking about. These are the long-term fundamentals from 26 to 2050. And so what we're seeing is that these plots are showing you the average of every hour in August. So we're focusing in on the summer period for this snapshot. And so in 2026, we're looking at the average dispatch. And as you can see, our battery storage dispatch is largely concentrated to those evening hours when the sun is setting. And it looks quite similar to what we're seeing today. We see most of the battery charging in the early morning hours where load is low and you have good solar resource. So if we move from the left-hand side, I've shown in the slide here all of the load growth. And there's so many things to notice in this next slide here in the 2050 average August. But I think the most considerable one is that while we're seeing, the level of gas production, we roughly see it at the same. There is growth in gas build out across the outlook, but really it provides an average level of baseline production, and it's really that wind, solar, and storage that takes on a large majority of load growth on average. We also see coal retirements also playing a pretty strong role as well. So that's one thing to notice. The other large thing to notice is the battery storage dispatch is now, as you can see, it's still pronounced in the first 2 hours in which the sun sets, but it is dispatched all across the evening. So we're seeing longer durations of battery storage, covering a lot of hours across the evening. And also we're seeing, that solar resource being a large contributor to when all of that storage is charging during the middle of the day over those peak loads. Okay, so I want to leave some time for Q&A. So we're going to jump into these last two sections on how we are tackling nodal forecasting, nodal long-term forecasting in ERCOT, and also looking at energy storage economics. So at E3, we have a three-step approach to nodal price forecasting. We call it the three levels, and each have more and more granularity into how we approach it. So the first thing that we typically do is we will take in and do some analysis on historical basis at any given node to its hub. And so you can see on the right-hand side there in that first tranche what that looks like. We've got a historic day-ahead basis profile and a real-time basis profile. And we have some proprietary scripts that bring in the data. We do things like data cleaning and outlier detection. And we then provide an average year of what the basis looks like. So you can kind of see that in the bottom left hand side there. And then we then take the historic basis and we look at things like the local interconnection queue, what type of builds could be impacting congestion or mitigating congestion, things like wind and solar growth, things like storage growth, and also transmission expansion or local loads being expanded there. All of these can impact the flows on the system and impact what the basis looks like to the hub over time. And so we take all of that in and we do benchmarking against our long-term zonal forecast and what we're expecting basis to evolve as, and then produce a final adjusted nodal forecast from the historic basis. So to give you an example of what this looks like, here's an example node in ERCOT North region. So some of the heat maps, as I mentioned in level 1, we look at what the historic basis is after our script runs and calculates this heat map table. So what you're looking at in this example, and I've highlighted the summer months, is in this node, for example, in August, we're seeing the largest basis differential where the node is below the hub on average, $7 for, let's say, hour ending 16, for example. But then we always see interesting dynamics between day ahead and real time. The real time node, we see, again, that same slight basis in the summer, but highlighting here that there's a winter basis if we have any winter pricing events. This node typically saw congestion and had an outflow constraint and couldn't capture the high winter pricing. So we take all of that into consideration, and then we also look at the, as I mentioned, the near-term local interconnection queue, and we have another model that assesses how the change in build on the local system will impact these basis profiles on the right. Okay, and finally, I'll take us home here and we'll get to the Q&A. As Nate mentioned at the very beginning, one of our marquee in the project level models is Restore. And so Restore is our energy and ancillary services co-optimization engine. And what it does is it takes in our stream of real-time day ahead and ancillary service pricing from the long-term forecast, and it walks through it and it determines what the optimal dispatch for different battery strategies would be to maximize revenue given the curve. So as Nate mentioned, it's a price taking model, and we run it with a couple of different strategies. So we run a day ahead and real-time energy only strategy. So it ignores ancillary services and it looks at what are the best arbitrage opportunities every day to cycle and capture. It both looks at the day ahead and the real-time energy market. And if there's room for real-time to improve day ahead, it will be assumed that it didn't take a day ahead award and it would go after that real-time. So a bit of a perfect foresight run. And then we have the energy plus AS revenue full co-optimization. And so as many are likely aware, energy storage, when it's providing things like contingency reserve, it's maintaining its state of charge. So it's getting paid to maintain state of charge. And so that co-optimization brings out, an interesting dispatch of when is it most likely to be providing ancillary services, or when is it going to go after the energy arbitrage opportunity. So a final step we make to create our core revenue forecast is we integrate both these optimized energy and then optimized energy plus AS revenue. And we look at what the probability that any storage project can clear in the ancillary service market is. So as we've seen, and we'll talk about in a second here, batteries being so large in ERCOT, they compete pretty fiercely in the AS market to win awards. And so we then do what we call blending, which is where we take a clearance rate, which is shown here as the size of the AS market divided by how many batteries are trying to get into it. And it assigns essentially a probability that any individual project will clear in the AS market. And so then we create our blended forecast. So some example output from ERCOT here. We've given you a snapshot of what we're seeing batteries participate in long run, given our energy and AS forecast. As you can see, even in 2026 here, storage is already quite heavily saturated the AS market, giving all of ERCOT's ancillary service products lower capture prices, which is really forcing the batteries to go into and cycle in the day ahead and real-time markets. And as you can see, we're projecting in 26 here. Again, that's where we're starting to see the market recover from all of the supply built in 24 as load growth starts to come in. So we're seeing stronger revenues in 26. And then long run, we're expecting with such large load integration and as the system builds out with strong wind and solar, we're seeing a large opportunity for that 2-hour and then longer duration windows as well, providing some strong pricing in 2040 and 2050. So that takes us through the presentation. I'm going to hand it back over to my colleague Nate here to do some Q&A with me.
Yeah, thanks, Grant. And thanks everyone for your participation, attendance, and some of the questions we've gotten in the chat. I think I'll maybe just, in the interest of time here, cover a couple of those questions out loud for the broader group. So, one question was around the sort of net impacts of the recent reconciliation bill on total renewable builds in the market. And, as Grant touched on this earlier in the presentation, what we do see is an acceleration of specifically solar deployments to take advantage of the tax credit window, specifically starting construction the next 12 months for safe harboring and, trying to get online the next couple of years to kind of lock in those tax credits with higher confidence. And then after that, long term, with the expiration of the tax credits relative to our previous outlook, which was a IRA that had tax credits in effect through 2045 based on the economy-wide US decarbonization standard embedded in the legislation. So, we do have a longer-term, higher cost projection for wind and solar and storage after the roll off of those tax credits in the current outlook. And we do see a material haircut, but it's not like the market collapses and there's no more wind and solar. It's sort of on the order of sort of 10% or so relative to the previous forecast, or 15% long term. So there's a reduction, but you still need new energy in a growing market. And so, as Grant was touching upon, it's the balance between the effective cost of combined cycles entering the market in volume in the later years against wind and solar, and the wind and solar weighted capture prices that we see. And so that's why we understand and expect the market to stabilize at an overall higher level of around the clock energy to support that new entry, all of which is at elevated pricing relative to our previous forecast. Um, that's one. I think another question here that's probably going to be good for us to cover briefly is, how do we account for uncertainties? As I mentioned earlier, this is a deterministic model because we want to be able to illustrate and draw for our clients those relationships between cause and effect. This level of load, this profile, this hourly shape, this renewable profile, and what the intersection of those are. Now, we also have three different scenarios for Texas given the fundamental uncertainties in the market, and those scenarios are built upon different cost expectations for new resources and different load expectations for growth over the long term. So I just wanted to highlight for everyone that we've been talking about kind of our core scenario, which is kind of our baseline scenario, but we also have a high growth and a high renewable growth scenario that will also be publicly available and updated post bill shortly. I also just wanted to highlight for the broader group here that we focused on Texas and our reading of the OBBBA, but we also have market forecasts available for every major ISO RTO in the United States. We also have forecasts for the ASO, and we've done work in Ontario as well. And specifically the non-California WEC with EDAM and Markets Plus, we have forecasts coming out for each balancing authority zone in the WEC under those paradigms. So there's a lot more to come in terms of E3's market narratives and expectations in the current environment. And I think with that, we'll probably wrap up here. And again, thank you all for attending. If you have any further questions or interested in learning more about our forecast, our services, or views, please reach out. Our email addresses are there. We're available on the website, and I really appreciate everyone's attendance. Good luck out there.
Thanks so much.